Good morning, ladies and gentlemen. We've had the FOMC, we've had the dot plots. Let's see if we believe them. Because if we do, then the picture for us is not great, but I don't think they believe it themselves. So without further ado, let's have a look at what they're projecting, how they think the path of interest rates going forward, what it will be, and what the implications are. So here we have them. So GDP up to 1% from 0.4, so that no recession in 2023, no recession in 2024, no recession in 2025. Unemployment, they were looking for 4.5, now they're looking for 4.1, but they're looking for 4.5 in 2024. I'm not really sure how that happens, and we still have 1.1% in real GDP, but there you go. But these are the ones that make little sense to me. The March projection for, let's have a look at core PCE, was 3.6, and now it's 3.9. For it to be 3.9, we're going to have some very low inflation numbers going forward because we already got 5 prints. And we are keeping the 2024s at 2.6. What does all that imply for the dot plots? I was bearish. I thought the dot plot would be just below the 5.5%, and I got a shock. It's 5.6. So they've penciled in a full 2 hikes this year. And then if we have a look at 2024, what they've done is basically kept the real interest rate constant. So they're saying that we're going to be, let's call it 4.5% from 5.6. And that is all due to the change in the lower core. So they're actually keeping the real rates of real interest rates constant. They're just bringing them down by however much the core PCE comes down. Tough to believe, okay? Tough to believe because either we have a constant acceleration of GDP like they showed, in which case, why should these dot plots be any lower than the ones in 2023? Unless inflation comes down substantially more. But I can't see how inflation is going to come down substantially more if the real GDP keeps on accelerating. To me, that's unlikely, but what the hell, it's possible, but it's low odds. I just can't see why that would happen. We can all forget about 2025. That is, no one has a clue what's going to happen in 2025, and neither do they. Look at these dot plots. They make no sense whatsoever. So the real dichotomy here, and we'll go back to these figures, is how is GDP, real GDP, going to accelerate or stay this high? They've more than doubled it for 2023, and they brought it down by 0.1 for 2024 and 2025, which really means nothing because they have about as much clue about that as you and I do. The unemployment rate comes down, okay? So the projections for the unemployment rate are down. GDP is also down, which makes no sense. And then the core PCE comes up. And we're supposed to believe that they're going to be able to cut rates in 2024. Okay, I don't believe them, and I don't think the market is going to believe them either. Let's have a look now what the yield curve has done and what it's likely to continue doing. So what did the yield curve do? Well, it did the obvious thing. It took 2s higher, because now all we have to look forward to is 2 more rate hikes predicted for this year, 2023. It really doesn't matter when they come. July is now, I would say, 100% certainty, because if they now don't hike in July, who the hell is going to believe those dot plots? And who the hell, all their projections will make no sense if they don't hike in July, and then another hike sometime in the autumn. That's fine. And then they say that they're going to bring rates down in 2024 by 70 basis points, 80 basis points, which it basically matches the fall in the core PCE. Okay, I'm just about on board with that. But if there's no recession and real GDP accelerates from their projections, then why would they ever cut rates by more than the rate at which the core PCE is falling, and therefore keep real rates, I stress, constant, i.e. around 1.5% real rates. So whatever core PCE is, you add 2.5%, you add 1.5% to it, and that's your Fed funds rate, let's say, or maybe just 10 basis points above. So if we get to 2.5% at some stage in 2024, late 2024, then rates are, Fed funds are 4.10. Well, that's not going to happen until very late in 2024. And in the meantime, all we have to look forward to is more hikes. So this level of 480 in the twos is probably still too low, because I don't think that core PCE is going to fall below 3% next year. And if that, because we have a lot of inflation to come, not in all kinds of things that are going to drop out of the index, like the very low oil price and so on. So if the oil price doesn't keep on going down from these levels, we're going to have a natural rebasing of the inflation next year, which tells me that the chances of sub 3% core PCE next year are very low, which keeps Fed funds at least at 4.5%, at least, more likely 4.75. So we probably have a 75 basis point drop to look forward to in 2024, but that is still not really reflected in the 2-year. The 2-year is more likely to go higher, and so is the 3-year. So I really don't see, everything else is completely unchanged, because it says, right, we're going to believe you for now, and we're going to keep real rates where they are. Okay, so now let's have a look at real rates. And here we are. The market is basically saying, okay, you're telling me real rates are going to be 1.5%, so I'm going to hold them at 1.5%. But the real danger is that they are wrong. The real danger is that inflation reaccelerates next year and this spikes higher, in which case we have a complete debacle in the bond market. Because now it's pricing in what the Fed is telling them to price in, and the danger is that the Fed is completely wrong. And then inflation actually accelerates next year, and instead of having more cuts, we have to start pricing in more hikes. That is what I think. But in any case, what the Fed is basically saying to you is that it's putting a floor on rates. So all the danger is now to the upside. So if I'm right, and basically what the Fed's message is, what we will keep the real rates around 1.5%, and that is how we're going to manage the economy, in that case, the move index has to come down, right? Because rates are going to be held constant, and the only variation is going to be with the core PCE. So if the core PCE is not going to move 1,000,000 miles, rates aren't going to move 1,000,000 miles either. Therefore, realized volatility in the market is going to be lower, and therefore the option volatility priced into the options has to be lower too. And guess what? The move index is coming down, and it's now at levels that we haven't seen since May of 2022. And I think that we are going to have a move lower in the move, all the way down to the 90s, where it could possibly bottom out. Because let's face it, the Fed is telling us that we are only going to respond to, from now on and throughout 2024, to moves in the core PCE, and we're going to hold it. We're going to hold rates, the short-term rates, constant relative to the move in PCE. Okay, well, that has to bring down volatility. And if all the danger is to the upside in rates after that, because PCE could come down a lot slower and is much more likely to come down a lot slower than they think, then selling calls in the bond market becomes money for nothing. So let's have a look at how the yield curve responded. Let's start with something really short, 2s, 3s, new highs. Let's have a look at 2s, 5s, new highs. Let's have a look at 2s, 10s, going towards new highs. Let's have a look at 2s, 30s, filling this gap. We've done it. Slowly, slowly, we will go towards new highs. The yield curve cannot do anything but flatten here, because if we are expecting lower PCE next year, right, lower core PCE, and we are expecting them to keep the real rates constant, then all it can do is flatten more. It can't really do anything else. So if we go now to the individual 10-years, and let's go with the 30s, it's telling the 30s you are going to remain in a very tight range. And basically all you're going to respond to is very small variations in inflation expectations, and so you're going to remain in a 30-40 basis point range. You're going nowhere, because how much are inflation expectations going to change over the course of the next month or two? Very, very little. 5 basis points here, 5 basis points there. So the 30s, the Fed is telling the 30s, you're stuck, you're going nowhere. 10s, much the same kind of thing, right? Because 10-30s are very unlikely to break par. So if we have a look at the 10s, 30s, which is wonderful, if we ever get here, okay, and we fill this gap to -1, I'm all over it, because I've never lost money by going long 10s and short 30s at zero. And I'm very unlikely to, if I hold on for a month, I might have 10 basis points, 15 basis points of pain, but I'm also going to have 25 basis points of reward. So the 10s and the 30s are stuck. The 5s are less stuck because, they're closer to the 2s, so they can bounce off this 406. And the 2s, well, they keep on staying here and eventually break and go back towards the 5% area. Why? Well, if the Fed is telling you that they're hiking, and they're hiking to 5 let's call it 560, as the dot plots say. That means that you should be able to get an RRP of 560 sometime over the next 6 months. And let's call it an average of 540. That means that for something like 9 months, you're getting 540, and then you're getting 5% for another 9 months, and you might get 4.5% for a few months at the end. Well, 470 is not a bargain in that case. If you average that out, you're much closer to 5% than you are to 450. So this is not a huge bargain. And also, if the inflation if the core PC starts missing, that means you can forget about 2024. And this has, the tendency to go above these highs. So really, what the Fed is telling you is to sell calls on the futures, i.e. these rates are going to go down very, very little, if at all. Even if you have some sort of positive surprise to the inflation numbers. And you're not. I mean, it's going to be 0.1 here, 0.1 there. So really, all you're looking for is very small movements possible to the downside. And if things miss, much bigger movements to the upside, which basically just tells me to sell calls because the move index is going down and all the surprises to me are going to be to the upside. We also had the ECB, and we got a very, very similar message, if not identical, from the ECB. So let's have a look at what that yield curve is doing. Let's have a look at 2's 5's flattening. Let's have a look at 2's 10's flattening. Let's have a look at 2's 30's flattening. You get the message. The 2's in both the US and Germany have got nowhere to go but up. The 5's are going and the 10's are going nowhere. So we are in a very tight range. Again, the message is the same. Sell calls. There's no difference. This is going to be throughout the summer, a market which goes nowhere down in yield. Okay, it might go down to 520 whatever, but you just sell that strike. You just go away, sell it and go away, because all the danger is that inflation does not come down as fast as they expect, and that actually we get some some upward surprises. We have until the next FOMC, we have one more CPI number. It's very unlikely that we have rates anywhere below the what we are at the moment, because the crosses, both in the are going nowhere as well. Okay, you're seeing where the crosses are. Every time they get to something around 170, gets sold back down. And let's have a look at 10's. Every time it gets up around the 140, it gets sold back down, and then it stabilizes. We are in a stable situation in both the crosses, the yield crosses, and also the individual tenures, with a tendency to keep on flattening. And every time it steepens 10 basis points, I'm going to go in there and flatten the curve again. That's all I can do. And in the meantime, I sell calls on the shorter tenures. Something like 2's and 5's, you keep on selling calls because, rates are not going to come down. It's as simple as that. Well, I was completely wrong about the dollar. I thought that the differentials would keep it bid. It didn't happen. I'm rather surprised because the FOMC was hawkish and the interest rate differentials, I was right, they did go down and that they went back up slightly, but on the week, you know, they were higher. You know, the US rates were higher than German rates. So I don't know what is going on. Good thing I don't particularly trade the FX. I think it's unlikely, though, that we get a collapse in the dollar. I think the stability is more likely than not. So the levels that I would look to sell, and we are, you know, quite a bit through the Bollinger Bands, would be, you know, somewhere around here, somewhere around 109, 109.70 would be the first level that I would sell. But there you go. It is what it is. It looks to me like slowly, the primary trend, we've turned the moving average, it'll tend to go higher. Why that should be, I am struggling to understand. And the only answer would be a complete collapse in the inflation differentials, i.e. that the Fed at some stage stops hiking and the ECB keeps on going, or that the Fed or that the US economy goes into some kind of a recession, which doesn't affect Europe. Why, you know, it's a tough proposition to believe. So I really can't see much higher levels of Euro USD. It doesn't make any sense to me, but I can see that I'm wrong at the moment and best to keep out the way. Gold was very disappointing to me last week, insofar as I really did think that it would break down and continue lower down towards, you know, let's call it 1890, if not 1881. But then the dollar turned round and weakened, and that propped up gold and kept it above 1959. It's interesting how we just can't close below. And, you know, that indicates that at some stage we're going to start pushing higher again. But since I see very little upside in bonds, and since I just don't see that the inflation differentials between the US and Germany are going to be positive for the dollar for that much more, I'd still rather sell rallies in gold than buy dips. I just can't see what the attraction is in gold at the moment. The only attraction would be if the Fed abandoned the hikes and they said, okay, we'll let real rates drop towards 1%. But they're not saying that. Maybe the market doubts that they will have the guts to go in July and then tighten further like their dot plots imply. I don't know. It's puzzling to me. I think the natural way for gold is to go down towards this 1881 level and trade around there, given what I've told you about bonds. And, you know, the dollar is the spoiler and was the spoiler last week, because if the dollar hadn't gone down on Thursday and Friday, we would have closed well below 1959, headed down towards 1881. It seems that we are just going to be in a range in gold, just like we are in a range in long bonds, and waiting for the surprise. I fear that the surprise, and maybe that is what gold is actually telling us, I fear that the surprise is going to be in higher rates, and that the Fed is going to have to, at some stage, panic to the upside. And maybe gold is saying that it does not believe that the Fed is going to have enough guts to really bring inflation down to heel and keep real rates up at 1.5% for very long. Looks like that is it. I don't know. I'm going to keep out the way of gold because it's giving me contradictory signals. I still think it should trade down. It's not. Get out of the way and wait for the next narrative, because this one isn't working. I'm actually getting slightly positive DBC and commodities in general, because we just can't get down to 21.75. And look at it, we've had the highest close in what, couple of months. So really this 24.39 area is quite possible. And have you ever looked? I kept on saying I prefer commodities to gold, and that is going down, and I expect it to come down towards 736 here, and then probably it's time to buy gold. But the one, DBC is like 65% oil. And oil keeps on bouncing off this 200 period weekly MA, and really basically saying that it doesn't want to go below 65. We are still below the 200-day moving average, therefore we are nowhere near positive. But it's just telling me that we are getting towards the last part of this down move, and the 50s are unlikely, and that the risk reward on any dip is to buy it back. If we look at what copper gold is doing, is basically saying that we are, and not that it's worked very well this year, but it's basically saying that rates are more likely to go higher than lower. That's what that ratio is telling you. And copper, although it never got to my 350 level, got very close, and now it's in a range to moving higher. It just shows you that commodities are unlikely to start going down hard and therefore help bonds in any way. And that is why I can't really see inflation being that much lower next year. And here we are, copper is turning the 200-day moving average higher. So I see no reason to completely avoid commodities anymore. And therefore I see no reason why rates should go down. And really, I think the economy is more likely to surprise to the upside than to the downside as a result of all this. Well, let's have a look at some risk indicators to get the trend, as if the trend wasn't obvious. The trend is sell bonds and buy equities. ITOT over government, so that's the totality of the stock market over the totality of the bond market. We are going higher, there is no question. SPY TLT, I mean, it's so obvious. It's broken to new highs, it's sustaining new highs. There is absolutely no reason to believe that this is going to turn anytime soon. Even if we look at something like the weekly charts, we are not above the weekly moving averages, Bollinger Bands like we were here. I think any and all dips are going to get bought. And if we have a look at ITOT over Gov, new all-time high close. To me, maybe a couple of weeks of sideways, but we are going to go up here without much doubt, 4.5 and higher. So equities still favored over bonds. And as I've been telling you, I think bonds are going to go nowhere. They're going to be in tight ranges. The yields are going to be very close to each other, and therefore really you are selling calls in bonds, and I guess at some stage buying calls in equities. So if we look at a weekly chart, where is the natural resistance? Well, I guess it's at some level like this, right? Which is 45.36. I mean, I'm not saying that that is the level, but somewhere around there. As you can see, this is where we bottomed and this is where we topped. So this kind of 45.30-ish level is the natural level that you would assume that the market can get to, even though it's now vastly overbought and through the weekly moving averages, which doesn't last very much, and it normally comes back to the red line, which next week is going to be around here, around 42.60, 42.70, 4300. You know, you're looking at maximum retracements of 2-3% for the time being, and then probably a fake up to there, and then you can see. But for the time being, I really cannot see that the stock market is going to be performing less well than bonds, which isn't really saying much because I really don't think the bonds are going to perform that well. So really a summer continuation of buy the dip in equities. The valuations in equities make no sense, but the technical picture is still telling you that they're going higher. For all those saying we can't get to 4,500, well, you know, yes we can. Earnings expectations really are beginning to turn, and the likelihood is that we keep on trucking, not because earning expectations are going to be that much higher, but if the bond market, if all that's necessary for the stock market to do better is that the bond market doesn't do worse, then I really don't see why we can't get to, 20 times. And what is that? That's like 4,600-ish. And I showed you where those levels on the weeklies are just now, above 4,500, whether it's 45.30 or 4,600. I mean, that's 1.5%, right? So that is what you're looking. You're looking for a continuation of this move higher, while the risk keeps on increasing, because at some stage we've got to know that if we're going to have a recession or not. If the Fed doesn't think that we're going to have a recession, I very much doubt that their inflation expectations are realistic. I think they're too low, in which case they're going to have to hike a lot more than they think, or keep rates much higher for much longer. And we're talking about no cuts in 2024. We're talking still hikes possibly in 2024. And then you get the real interesting response in equities. But I don't think it's going to happen just yet. I think for the next month or so, we still continue higher. Certainly in the ratio between bonds and equities. I'm watching the Dow more and more, because if the Dow stocks now start joining in the party and NQ doesn't start going down hard, which is unlikely given the AI narrative, i.e. NQ can just go sideways and it doesn't do any harm, then if the Dow stocks start joining the party, we are in extreme danger of going up to 36,006. So that's another 4-5%. Easy. So you can see from this monthly chart, and let's enlarge it, that basically the Dow has been going sideways for over 6 months. If we start breaking above on a monthly basis, and certainly if we close this month above, I really don't see what's going to stop us until we get to 36,500 and test these highs. And that just shows you how much momentum stocks can carry, because even if you say that this is an ABC and, you know, it's going to go another, this is 31.3 against 34.3, that's another 3,000 on top of here. So that's 37,500, which is up here somewhere, right? So this is, you know, this is going to be a very interesting period, because either we stop here and we start coming back on valuations alone, like I showed you, or we actually start going quite a little bit higher. And that's why I think volatility being this low enables you to buy calls relatively cheaply and buy puts to protect yourself. So stock replacement, which is what I'm doing to my own portfolio at the moment, makes sense. You sell your equities and you buy calls, or you buy a straddle, because I think things are going to move quite a bit, and the fact the volatility is this low, you know, 13% real, you know, vol, enables you to buy 3-6 month volatility relatively cheaply, and certainly it's not at 13%, but there you are, because longer term vol is higher, but it gives you the possibility to participate on a leverage basis on a move up here, which I think is more likely to happen than not. I can't see the Dow breaking below 32,005, and I can certainly see it breaking up. And if the Dow stocks join the party, then you're going to have quite a little bit of upside. EM is also showing you the way. This is a weekly chart. I think, you know, there may be a couple of weeks of hesitation, but I think every time it now drops to 40 or just below, it's a buy. This to me indicates a market which is going to test here the 42.25 area. And certainly there are some very, very bullish charts of non-US stocks like Latin America, my favorite, Mexico and Brazil. So I think this break here is significant, and I would recommend buying any dips in EM, certainly up towards 42.25, and that's a, you know, 5% move. So it's, I think EM is going up. There isn't a single market, foreign market, and this is Nikkei, that is looking weak at all, and is not saying that they're going to continue. Now, Nikkei is extremely overbought, and a move back down would not surprise, but certainly while it's above 33,000, call it 200, it's still immediately bullish, and you're not really expecting much of a reaction lower. You know, would I love to see something down to 32,000? Yeah, but I think it's unrealistic. I think this market is continuing higher, and even Europe, you know, it is not saying that it's weak. This is DAX cash, because I don't want to confuse it. It's made another closing high. It's not immediately impulsive, but it's certainly saying that any dips are going to continue to be bought. So I really can't see that there's a single market out there that's saying that equities, apart from the usual 1, 2, 3% retracement, are going to be anything but more positive than bonds over the course of the summer. And with that, onto the levels and biases. I mean, my strongest takeaway from this week is that the likelihood of bonds rallying, bond prices rallying, is very, very low. And still, you know, volatility is still likely to come down, and theta is your friend. In twos and fives, any kind of 10 tick rally in the fives, for example, is still an opportunity to sell at the money or even in the money calls. The short dated calls are trading, you have the Wednesdays, you have the Fridays. You can sell those with very much with impunity, I feel. The market is very, very unlikely unless an event happens, and then you're just unlucky. But in the meantime, I just keep on selling Wednesday calls, Friday calls, and they keep on expiring worthless. Every time it rallies, I sell a few dozen calls, and it just keeps on working out. So that is the logical position to have and the logical direction of the market. Have a wonderful Juneteenth or whatever it's called holiday, and I will tweet you on Monday.